Robschild. No investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro technicals, and of course, crystal ball gazing in that order. Today is Tuesday, January 7th, 2025. Today's episode begins with job openings. Lots of job openings. Job openings report came out higher than expected at about 8.1 million openings, much higher than the last read of this, which was actually revised higher October up to 7.8 million job openings. So we have a, from an up and down, very crude standpoint, we have a higher high, right? You have a lower low, lower high, lower low, lower high, lower low, and now a higher high. And so, from that basic charting standpoint, you can it suggests maybe we'll go sideways until maybe we see either a higher low and then another higher high, or are we going to see yet another lower low? Looking at it from a more zoomed out perspective, this is a line that is going down still. This doesn't look like a trend change, not yet. Next item on the agenda, long duration yields still rising. I mentioned yesterday's show, the 30-year Treasury bond yield, TYX, hit this sort of double top from April of 2024. I thought that would have more resistance there. There was no resistance there. We popped right through it. Looks like maybe we're headed to a double top again. This, the more powerful chart reading goes probably the 10-year note than the 30-year bond yield, but they're all relevant, within themselves and to each other. And so another sign that maybe we're at the top of yields. You're going to hear me say this until they reverse, but whatever. TNX, the 10-year Treasury note, if you take these two bottoms and make a parallel, that's what all this blue is, parallel to this high here. That's what we touched today. We're testing that on the 10-year Treasury note yield. Some technicians are saying, we're headed up to probably the 5% mark to maybe get a double top kind of a thing. And again, just with the 10-year itself, we haven't gotten to that April high in the 10-year note yet. I'm still loading up on Treasury bonds. I bought a bunch more 0Z and TMF today to maintain 58% portfolio allocation to long duration Treasury bonds. Tomorrow on Wednesday, ADP employment report comes out. This also gives a clue as to what's going on with employment data, plus the initial jobless claims comes out a day early because of markets being closed on Thursday. Normally it comes out on Thursday. Markets closed because of Jimmy Carter's death. Also, this week as a whole, the most important thing coming out is Friday, the big, all-important employment-unemployment report. This is what triggered the SOM rule. If the unemployment rate proves to be higher than expected, moving higher and higher, that's like the sign. That's the alarm bell. Things are slowing down. That's what causes bear markets and stock market crashes. Could happen, could be nothing at all. Daily reminders, nothing's changed since my show titled Friday the 13th with Tornado and the Ball. These are things important to really understand thoroughly and have in the back of your mind for anyone that's serious about active investing. It's a lot to go through, and I'm not going to do another episode with this unless we get some major updates. For today, PE rose back up to 31 and Cape ratio are at 38. No significant changes. Equally, no significant changes in the crystal ball readings nor my portfolio allocations. I also explained those on that macro show. On to the charts, S&P 500 going down with a formidable large red candle, 1% dropping. Some people call Tuesday, by the way, turnaround Tuesday. There's a phenomenon that sort of happens on a weekly basis that if Monday goes down, Tuesday goes up and may have legs to go that way, and equally with the opposite. When you have Monday showing strength, turn around Tuesday going to the downside with perhaps some legs to follow. We'll see if it has legs. Any way you look at it, apparently, the market saw job openings as, tighter Fed. And we can see that in the Fed funds futures. We are pushing our first cut all the way out to, it looks like, June of 2025 now. I mean, I have better reasons to be bearish on the S&P 500, that don't involve, the daily swings of what Fed funds futures believe, but, certainly contributed to the bearishness of the day. Next chart that caught my eye, DXY, the dollar index, seeing so much weakness over the past 2 days, I was kind of like, all right, is this going to recover to, rip higher, or what's happening here? Today proved that we're sort of wanting to go sideways for a little bit. This does not look necessarily bullish or bearish at the moment. Dr. Copper, with a PhD in economics, certainly caught my eye today with this very precise head and shoulders top on Dr. Copper. We tested it again yesterday, and we broke through it to the upside today. By professional money, this may count as a degradation of the head and shoulders top. I think what professionals want to see is actually a close above. I think it would be the breakout candle, right? So we need a close above $4.22 to confirm that this head and shoulders top is completely negated. However you want to look at it, it's certainly showing more weakness in this trend line that I have here. I'm still sitting on a very large short position on SMH, and that did well for today, going back towards my favor. Notably, I was surprised to see SMH jump to the upside, up 3.3% on a closing basis yesterday, and then today, large move down, engulfing the heck out of that. I was looking for, are we going to get a closing candle above the wick of yesterday, showing more strength? No, siree. There's plenty of selling pressure here. Part of the reason for this is you have the CES conference this week, ends the 10th. I know it well because I'm keeping my eye on monitors right now. And yeah, we got good news from NVIDIA, right? Coming out with a 5070 chip being only just over $500 and just as powerful as the 4090, their most previous powerful commercial, or I guess we call it a retail graphics chip. Pretty exciting stuff. Yeah. It's just amazing how, I always think, oh, this is it. There's no way they're just going to keep doubling the power of computing for people forever, and they just keep doing it. It's absolutely fascinating. But I digress. I don't know all the reasons. Supposedly, part of the bearishness in the semiconductor industry was NVIDIA didn't come out with any kind of groundbreaking commercial technology that the market was kind of hoping for, because of in the past they had been coming out with, great new chips. Just every time they have an opportunity, they announce something big, and they didn't announce something big enough, so NVIDIA dropped itself by about 6% today. The market was obviously hoping for better stuff coming out of there. Next chart, K-Web. I mentioned yesterday how Tencent recently got in the news as being regarded in the U.S. as involving military technology, so it would be taken out of things that Americans can invest in, something like that. I thought that would have been more bearish for K-Web. Instead, today we only went down about 0.6%. Notably, this is less than most of what the sell-offs in U.S. equities, but you have to expect that. If you understand anything about valuations, when valuations get overly extended, when you have PE ratio of the S&P 500 sitting at 31, there's an excessive amount of speculative price built into the price of those equities. And so when things fall apart, something with a lot of speculative value has a lot more potential to fall a lot harder, is the way I would put it. So, yeah, Chinese equities, it's like with these being on the opposite, completely in the opposite scenario where these companies in China are clearly extremely undervalued. It's like, how low can they go? It's like eventually, um, you know, eventually the price just gets so attractive that you have people like me coming in and scooping up as many shares as we can afford. I mean, but I digress. Next chart to catch my eye today, Bitcoin dropping by 5% today, the day after, of course, after I get out of my short. I short down here at the bottom and I get out of my short at the top. That's how you're supposed to do it, right? Yeah, so one thing that I do with my investment decisions is, first of all, I always assume when I do something that I'm going to be wrong, and I ask myself, am I going to be okay with this? So I set myself up psychologically to be successful no matter what in that way. And in this case, I had set myself up for that too. I said, well, what if I'm wrong? What if it drops by 10% tomorrow? Well, I already said to myself I'd be okay with that because, like I said, my concern was maybe a decoupling from other risk assets in the market. And, again, my goal of shorting Bitcoin here was to catch it going from 92,000 to 75,000, and we're still above that level. And so from my perspective, we could still go up, down, sideways. I don't know where we're going in Bitcoin, but congratulations to the professionals that squeezed me out of my short. They didn't make that much money. Again, my position was 1.5% of my portfolio, losing about 10%, I think. So that equals about 0.15% of my portfolio. I can handle that. When the S&P 500 can move by an entire percentage in one day, 0.15%. I'm not going to lose sleep over that at night. Just one other thing about that discussion while I'm on it and talking about it. Percentages matter. When you're looking at your portfolio it doesn't matter if you're dealing with $20,000, $50,000, $100,000, $1 million, $10 million. It's, if you think of it as like a game, like if you had a currency in a game, it doesn't mean anything to you because it doesn't affect your real life. You don't have to use the money to actually buy things. But when you put it in your head as it's a game, you don't worry about it. You don't fret about it. You do things that are that make sense to you, and that's it. And with markets that do affect your real life, always assume that you're wrong. Say, when you're buying something, when you're shorting something, say, I might be wrong about this. It might do this instead of what I think it's going to do. Am I going to be okay with that? If the answer is no, maybe reconsider. If the answer is yes, my philosophy on it is go for it. Last chart of the day. Well, what about the really crazy money out there? What about the rest of the crypto market minus Bitcoin? I love this chart, Total 2 it's called on TradingView. It says right here, crypto total market cap excluding Bitcoin, having a huge engulfing candle of 4 trading days, dropping by, as it stands, 6.6%. When liquidity dries up, the most speculative assets, they're not going to have buyers, and when it goes down, people are going to get scared, and it's just how the game works. And the other thing is, the beautiful thing about the bond position is that the higher the yields go, the more liquidity dryness is out there because those yields exist. like a 30-year treasury bond, if you're going to get 5% locked in for 30 years, and then people start sniffing out, hey, well, maybe I'm not going to get 5% returns in my Bitcoin or my fart coin or whatever it is. It's real. Look it up. And it's supposed to be the newest, hottest thing that AI came up with, I guess. Sorry, I digress. But the point is that when treasury yields are that high, again with the dollar not even dropping in value here, the dollar is maintaining its value. There are marketable securities out there, very extremely liquid, huge market securities out there that are offering a guaranteed 5% return over 30 years. Yeah, it makes it more attractive, and it snowballs liquidity to dry up, is the way that I look at it. But anyway, exciting times, very exciting times in markets. Is that all? That's all. That's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.